I think we've been given the go ahead to start. So, good morning. Thank you all for joining in on a Saturday morning. Today's topic is analyzing debt mutual funds. Uh, I'm also a little surprised to see me do this because I'm usually doing more of uh, equity webinars. So this is a new thing for me also. Though we have an in-house debt team that uh, does the research work for fixed income. I thought that I'll take it as a challenge for me also, where I can come in, start to test my knowledge a little bit, and do this webinar. So I've kept things very, very simple, very, very easy to understand, because I'm also doing this for the first time. So I've kept things a little simple, but going forward, I would add a lot of complexities, to our interactions. Okay. So everybody thinks that investing in fixed income is difficult. And why do people think that right now is because, well, you had many issues. You had the INFS default, you had the Franklin issue, you had the bank PMC bank crisis, you had 81 bonds being written off, uh, which is a very big problem, right? Then you've had this reversal of indexation benefit on debt side, right? So investing in debt has become very, very complex, right? Uh, and a lot of issues have taken place in the last 5 years. And going by that experience of the last 5 years, usually we are averse to taking that sort of exposure itself in the first place, and that's why you're seeing a lot of money go into equity market also in the last 5 years. Right. Though debt is a very, very big part, people use debt only, for liquid purposes, or if you have a particular goal in terms of meeting a short-term need, yes, definitely, you are looking at fixed income, you are looking at debt mutual funds, because obviously, you are going to get more than your savings account. So naturally, you would go there. Right. So you've had many, many issues, and this has made investors think that investing in fixed income is very, very difficult, right? And let's be honest, it is difficult, right? It is somewhat difficult, because you don't know what the issues can be in the future. You don't know who's going to go and default. INFS was a AAA rated paper that went out and defaulted. There was a DHFL default also. A lot of money was stuck there. A lot of investors were not able to get their money back also. At INFS, still there is that issue, where people are still recovering the money, right? Then Franklin Templeton was another, big issue on the credit side, because usually you cannot see past returns when you're investing on the debt side. Not you can see it on the equity side, but it's more riskier on the fixed income side, because that sort of thing has played out. And if you remember from my past webinars also, there is a quilt, that is that asset quilt, where we see yearly returns of each asset class of the last 14 to 15 years. And in that, you would remember that the first 4 years, that is from 2010 to 2014, were great debt years. Right. So if you look at that past return, you would naturally see debt returns to be very high. But eventually, going forward, your rates started to normalize. India started to grow stably. Our macro scenario improved a lot, and naturally, you saw debt returns are starting to come off. Right. So anybody investing with that sort of mindset, saying, "No, I'm going to get that much on the debt side," then it's completely wrong for you to do it. Right. So don't look at debt from a returns perspective. Look at debt something for you to be safe for, saving your money, right? To be safe. Right. These are safe instruments. Right. So let's look at some jargons on the debt side that you would keep hearing, whether it is on newspaper, whether it is in the fact sheet, whether it is you speaking to a particular advisor, speaking to anybody from our side, right? One, you would see duration, which is usually the tenure, right? And I have taken a fact sheet in the next sheet where you would be able to see what actually is that particular duration that they are sort of referring to. Then there's the coupon, which is the interest that you're getting it, right? This is not the return. This is the interest that you're going to get off that particular product, right? Whether it is a bond or whether it is a debt mutual fund. Debt mutual fund usually don't give out that, they don't pay out that interest. But, you know, for a debt instrument, interest plays a very big role. Right? So coupon is basically the interest that you receive. It's not the return, it is the interest that you receive. right? Now yield to maturity. Now yield to maturity is your return, which means that let's say there is a 10-year paper, right? And you don't go in at face value. You're not going in on day one, right? Where you're going to hold it for 10 years. You start to you come across this particular paper, you come across this particular product, let's say 6 to 7 years in, right? So 6 to 7 years in, the price of the bond keeps wavering, right? So if the price of the bond is higher, then your yield to maturity is lower, which means there's more demand for that paper. So naturally, you're paying more as a component of price, right? To that of your coupon. So basically, you are paying more than what you are actually getting off from interest. So naturally, your uh, returns at the end of the 10th year is going to be lower than what you are supposed to make as part of the coupon, right? At the start, both are the same, but when as time goes by, you would see a lot of change in the price of that particular paper, price of that particular product. Naturally, because you're paying more, your in-hand returns that you are going to make of it because you paid upfront for that price component will be lower. Likewise, when the price is low, that means when people are dumping that particular paper, whether the demand of that particular product or that paper is going to go down, that means that the price is going down. Naturally, because you're paying less than what you're actually going to get off that paper, your returns are much more. Right, your end return at the end of the 10th year is going to be much higher, right? So that's what they mean by YTM. That's what they mean by yield to maturity, right? Spread. This is a very interesting concept. This is where you compare, different tenures. That means products of different duration to see what the historical spread has been between them and whether there's an anomaly, right? Like for example, AAA and the next credit quality paper, that is A, or triple B, there will be a particular spread. Or for example, your GSEC to the US Treasury, they have to trade at a particular spread, right? Why they have to trade at a particular spread? Because naturally the credit rating is different, the macro profile is different, currency plays a role also. So in relation to that, there is a particular spread, right? Usually you don't get such anomalies, but there have been times in the past, like 2018, during the INFS crisis, where there was an anomaly, right? Where the spread for AAA drastically went up, right? Which is an anomaly, which is not usually the case for debt, right? So in such cases, there are opportunities that open up for you now. There are opportunities, right? When you see a contraction or an expansion in the spreads, right? So that is a very, very important thing to look at, to analyze what's happening in the debt market. That's very important, right? Then comes credit quality. Okay, everybody knows about credit quality, double A, triple A, creamy, not so creamy. Then there are junk bonds. Usually in the credit space, you would have a lot of papers of low credit quality. That doesn't mean that they are bad. That just means that over a period of time, as their fundamentals start improving, they would start getting a higher credit rating, right? But usually you would see in India, majority of the debt market is government, right? So a lot of money is uh, your government papers. It's all government backed. So there's not a lot of worry. The only worry that comes in is from credit funds. That's it, because they are taking that risk of default. And you've seen in the past what the scenario looks like when there is a bad scenario like COVID, and it really goes out and affects the debt market, especially the credit space. Okay. So these are jargons for debt. What you should actually be looking for is basically the YTM, the credit quality and the spread. Duration, because you enter at that point of time, naturally, it just is an indicator saying, yes, for this much amount of time, this should be your YTM, right? This is going to be your returns. And this is not the same every time. This changes on a daily basis. This definitely changes on a daily basis. It's like a stock, right? But it changes on a daily basis. But because we don't have that access to price for most papers, we can't see it. But definitely pricing does take place, right? So if you look at a particular fact sheet, so I have uh, highlighted it as per the color. So if you see that red color of red quality, if you see red is your credit, which is AAA. This is public data. This is not an is not a recommendation, but naturally this is just one of the products that's out there. Right? So if you look at AAA, it says that it is a AAA rated fund, which means that it's a very good quality sort of fund. So that is 73% of that portfolio. Then sovereign, again, that's government, again is 22%. So basically the entire portfolio is uh, AAA. Right. Now, if you see duration, right, it says Macaulay duration. I don't want to get into the specifics of what that particular formula is or what does it denote, but what you have to assume is 3 years, that is 2.98 years, right? 3 years, your YTM, that is your analyzed YTM, that is your return right now that is there, is somewhere around 7.84%, which is very good for a debt product right now, which is very, very good for something of a AAA. Usually AAAs trade at trade much lower, but given the scenario right now on the debt side where there are multiple opportunities that are taking place, because we are in that scenario of high interest rates, we are getting a lot of opportunity on the debt side, right? So for that sort of 3-year sort of a horizon, you are getting a annualized YTM of 7.84%, right? So when you look at a fact sheet or when somebody tells you, the duration is so and so, yes, you can assume that, as of today, with what I'm entering, I would have this sort of YTM, and this keeps changing. And this is very sensitive to interest rates. That's why we say that interest rates are very, very important when it comes to debt. Right? That's why they are very, very sensitive. Right? You can't uh, negate that fact that given that it's a longer term horizon, let's say it's for 5 years, bonds are very, very basically fixed income is very, very sensitive to both interest rates and macro scenario, right? On debt alone, right? Debt has an inverse relationship with some of the factors, right? And these factors are basically duration and coupon, right? So for example, uh, when you're looking at a longer term duration bond, or when you're looking at a longer term duration paper, which is 10 years, 12 years, 15 years plus, what happens is, because it is quite a long term period, you are going to have issues when it comes to a change in interest rate, which means it's much more riskier. That you are taking this sort of risk when it comes to a longer term duration bond. Right? Why? Because things can change very drastically. Right? So for a longer term duration, you are going to have a lot of volatility when it comes to changes in interest rates. Right? Likewise, when you're having a product where your coupon rate is high or low, right? Again, you would have a lot of volatility in relation to that one particular product, right? So in that, you have to understand that you are going to have a lot of issues. You are going to have a lot of volatility when it comes to investing on the debt side. Right. So let's take a poll. What do you think actually goes on and affects interest rates? Is it inflation, fiscal deficit, current account deficit, or the credit rating of the particular product? So you can put your answers in the chat box. Okay. A lot of you have said all. A lot of you have said primarily A. Let's wait for more replies to come in. Okay, a lot of you have said A. Yes, you all are right, but I would go on the side of people telling everything. Yes, primarily all are a factor, right? Everything is a factor when it comes to debt. Why? Because, uh, like I said, uh, you are dealing with extremely long periods of duration. Right? So over a long period of time, all of these factors have a role to play in on the interest rate. Right? We've had periods where our account deficits have gone through the roof. Again, our debt market has gotten uh, affected. That's why in that particular period of 2010 to 2014, your debt returns are very high. Right? Now we are having this scenario of inflation, not in India but globally. Not in India but globally. Right? Not in India. Right? But globally speaking, there is a lot of issue on the debt side. There is a lot of issue on the debt side because your inflation is very high. The commentary that came in again from the Fed side was that they don't expect inflation to come down, and they won't change the interest rate unless and until there is a change on the inflation side. They will not cut the interest rates. Right? They're very certain that the only way where they're going to cut that interest rate is when uh, there is a cooling off on the interest rate side. Right. I'll just ask one more question. I think there was some problem with my audio. So if you want me to repeat a particular slide, please put it in the chat box. Or if you want me to start from the beginning, I'll start from the beginning very fast. I'm getting a lot of messages on the side saying that I think there was a couple of slides that I was on mute. So please do put in the chat box. If you want me to go through a particular slide, I'll go through a particular slide very soon. Okay, there was an audio on the inversion slide. Okay, so I think if that slide is clear, then I'll move on. If that slide is not very clear, I'll go back to the previous slide. Okay, so this slide, right, where we have to understand the inverse relationship with debt. Yeah. So is the slide visible now? My audio is clear. Just give me a thumbs up. Okay, perfect. So in this slide, what is important for you to understand is that debt has an inverse relationship with uh, prices. Like I said in the beginning, when the price, that is when the demand for debt goes up, you will see that you are getting a much lower yield. Why are you getting a lower yield? Is because you're paying more for that particular product. It's just like equity, right? When equity, you're paying more in terms of valuation. You're paying more in terms of any sort of valuation metric that you look at, you are going to forego future growth. Likewise, on the debt side, when you're paying more, that is when the price of the bond goes up, your end of the day return, that is after the tenure, let's say it's a 5 or 6 year paper, you enter in at the third year. Naturally, for the next 3 years, if the demand of that particular product is high, like a corporate bond or something, right, you will have much lower returns than your interest component. Likewise, on the flip, when there's fear, which means that when the supply of debt is very high, right? When people are dumping their papers left, right, and center, all of the mutual funds are dumping their papers left, right, and center. You see people dumping their bonds left, right, and center. You will see that the yields go up, right? Like for example, INFS 2018 AAA, very, very attractive. So investors who invested in AAA during the 2018-2019 phase, uh, benefited a lot on the corporate bond side, which where it was somewhere around 9.5, 10% return, right? So if you see now from the previous slide, you are having corporate bond, which is somewhere around 7.8 or something, right? But back then it was 8%, right? So over a period of time, as you lock in at 8%, you get a lot of benefits. Right now, given the current scenario, yes, there is a good amount of benefit that's coming in there, right? So debt has an inverse relationship, and you can't take a debt call thinking that I would see the past returns and take it. No, you have to think given the current scenario only and do it, right? It's a good thing that I went to the next slide and got the poll answers. So in today's scenario, inflation is very normal, right? In India, it's not very high. It's quite decent, and we are managing it very well. So in relation to that, uh, shorter term definitely looks more attractive because going forward, uh, as and when we are on a comfortable state on the interest rates, naturally the spread would drop. So your shorter term side would look much more attractive than your longer term side, right? Why? Because of the next thing. The next thing is that it is sensitive to interest rates, right? Debt is very, very sensitive when it comes to changes in interest rate. Like for example, your tenure, right? Anybody who's investing in equity for 10 years, you would hear from us, you would hear from everybody saying that because you are going to take that 10-year risk, you are going to be rewarded in terms of returns after 10 years, right? That growth component is there in equity, right? But in debt, there is no growth component. In debt, there is an interest component. In debt, what you're looking for is some sort of a payout. Now, when it comes to payout, longer term duration are more sensitive to changes in the interest rate. Right? There's more volatility when it comes to uh, uh, the 10-year side, that is the longer term side, 10, 15, 20, because of any small change also that comes on the interest rate side. Why? Because 10-year risk you're taking. You are locked in for 10 years. Right? You cannot exit out. You are locked in. Right? If you exit out, then you have to take a loss depending on what the scenario is. But usually debt means you are fixed, you are locked in for that particular amount of time. Right? That's why you're going to get more and more sensitive when it comes to having a longer term tenure bond. Right? Second, where does this sensitivity come in again? It comes in when you are having a higher or a lower interest rate than the return, which means that if your interest component is high, again, you are going to face some sort of a problem or volatility when it comes to your debt product, right? So debt, when you see, has a lot of complexities, but when you break it down, one thing you have to understand is its inverse relationship, right? When the price of the bond goes up, not really a good time to go out and start investing on debt. But when the price comes down, which means that there is fear on the debt side, there is fear in one particular side of the market, right? Then definitely it's a great time for you to go out and start investing on the debt side because you're getting more than what you're getting on the interest component, right? Because you're paying low, your returns are much higher, right? Second, because it's very, very sensitive, you have to take into consideration the macro scenario of the country. Macros matter a lot today. India, best time in history. This is the only country that is offering you 7% sort of GDP growth rate to the world, right? We are going to be the third largest country in the next couple of years, right? So you have to consider some factors like inflation and fiscal deficit when it comes to investing on the debt side, right? Because to protect your inflation, you need to have higher interest rates. You need to make sure that the economy doesn't get too overheated, which means it's not going too fast, it's not growing very, very fast, where we are willing to pay whatever price for any particular good, right? To cut that sort of behavior, governments would increase interest rates like what you are seeing on in the US, and your interest rates might be high for a long time. Right. So you have to consider these two factors very, very important when you're looking at any debt product, right? Especially when you're looking towards investing in debt mutual funds, because debt mutual fund invest in a lot of papers. You don't invest in one particular paper. You have to invest in a lot of papers, right? So you need to take into consideration where you are in that particular debt cycle. Now I'll show you where we are in that particular debt cycle also, right? So we already did the poll. Yes, the answer is everything. But yes, all of you are also right when it comes to inflation. Now, you look at the policy rates in India, right? See, globally, what we've had in Europe and US is a drastic increase when it comes to interest rates, right? And you look at the contrast, you look at Japan, right? When I was doing a lot of equity webinars, I got a lot of questions on why should I look at Japan as an equity option? Because the returns that are coming in from Japan have been very large. A lot of investors and a lot what I'm reading on Twitter, seeing on YouTube, reading newspapers that investors are really fancying Japan right now. But you look at Japan's interest rate, it's negative. They are having somewhere on the 0% side. So we've decoupled. This is what we say when we say decouple, right? You've heard a lot when it comes to decoupling of interest rates, right? This is what we mean by decoupling. What we say by decoupling is that everybody is going to do what it makes sense for them for their own country, right? Say for example, China right now, they are also cutting their interest rates because their macro scenario is not that great. They are shifting from a old economy to a new economy, and their old economy, which is more real estate driven, is going through a lot of issue. So they are going through a lot of macro changes. They are trying to support and they are trying to give a stimulus. Now, when was the last time we gave a stimulus for the world? The last time we gave a stimulus for the world was during COVID. Right now, we have not given any stimulus, right? When it comes to developed countries. But right now, you're seeing certain countries like China trying to give a stimulus and inject some sort of liquidity into the market, inject some sort of liquidity into their country where they can benefit of it, right? But decoupled, right? India interest rates, they have stayed somewhere around 6%. They are somewhere around 6%, right? US definitely gone up, sticky, very sticky. Likewise, no rate cut, right? Europe has had such a sharp increase in their interest rates. They are also not looking to cut, right? Japan, 0% interest rate. This is the beginning of that decoupling era where countries and central banks are going to do what is going to benefit their country rather than going towards one interest rate. So whenever you hear, I think last week, 2 weeks back also, there were a lot of articles that came out in the market saying that interest rates are going to get cut off, right? They are going to come down in the US. So please take an advantage. This is a very, very good option for you to go out and start taking exposure on the US debt side, right? Then there was a lot of information that came out saying because they are going to cut, we are also going to cut. So Indian debt becomes very attractive. How does that make sense? How does that make sense? We are going to do what is good for our country, good for our markets, rather than looking at what they are doing, right? Though everything is definitely connected, but how is it that we are offering you 7% sort of growth rate and they are not able to offer that, right? So we have to look at our growth rate. So anytime you have this question of just because the US is doing it, we would do it. No, that era is gone, right? Why? Because macro scenario is very, very different. US has the highest debt right now on their books in history, right? Even in terms of GDP, it's at an all-time high. But India is very, very stable. India is very, very certain as to what is going to play out for us in the future, right? If you look at the budget, one more example of how there is decoupling happening, right? Budget, very simple. There was not a lot of changes when it came to tax rate. Not a lot of changes. Basically, it was just, yeah, we are going at a very stable pace. Now we will just try to support certain aspects of our country and let our country grow, let it go in cruise mode, and we are all going to benefit from it, right? The entire idea was to improve the standard of living in India, and that's what of Indians, and that's what the budget really was, right? So you are getting messages from all sides saying that no, we are in cruise mode. We are going to do what is good for our country. If there is a cut, if it's good for our country, we would cut it. Right now, it doesn't seem like there is a cut, right? So decoupling has happened. This is the era of decoupling, right? Look at currency and you look at interest rates. There is clear decoupling happening both in terms of growth also and in terms of interest rates. Now, let's look at this recap in terms of debt. Now you look at how there is decoupling, but you look at how our yields have sort of reacted, right? When the US hiked rates by 25 bips, RBI hiked by 25 bips. Then again, US hiked, right? Then our projections started to come up at 6.5%, and this is our GSEC. So if you look at our GSEC, as and when you start to see stability coming into the market, your yields are going down. So from 7.4, we came down all the way till 7%. This is that indicator saying that yes, there is demand for our 10-year GSEC, right? That's why you're getting a lower yield, which means people are parking more and more money on the debt side, right? There are institutions that are bullish on the debt side. Global investors are bullish on the debt side in India, and people are buying out our debt papers, right? Then if you look at our CAD narrowed to 0.2% of our GDP. So you're seeing there was a good period where, because our macros were looking extremely good, people were very bullish on the Indian debt side. You look at the next slide. I mean, you just go 1-2 months ahead. You see US Fed hiked the rates by 25 bps, but nothing happened to us, right? Because if you see, before there was an expectation that we would also go out and start going that way. But fact, it didn't happen that way. In fact, one positive thing happened, that India's inclusion in global indices became much more certain. Right. So you saw a lot of positives coming into the Indian debt market, right? And in relation to that, you saw yields moving, right? Which means that the demand of these particular products, the demand of this paper started to go up. Now, problems started to come in. Look at the fundamental problems that started to come in, right? You started to see wars taking place, and that's when yields started to shoot up again, which means fear that came into the market gave people an opportunity to take advantage on the debt side. Right. Now, at that point during the war, if you analyze and see whether India is going to get affected by the war, one, no. Second, because of the war, right now there is a Red Sea crisis. Can this affect the macro scenario of our country? Can this affect inflation? Specific parts of the market, definitely yes. So that is again very specific. We are not having any issue in terms of oil. We are not having any issue in terms of our commodities. We are not having any issue whether it is steel, whether it is oil, whether it is aluminum. We're not having any issue whatsoever. Right? Volumes are going up, which means that the country is in a good shape to weather through all of these wars that open up. We didn't have an issue on the Ukraine Russia war. We are not having an issue here, right? Because of all the breakouts, we are not having an issue here. So you are seeing that because there was only fear in the market, you saw that the US Treasury jumped up, all the debt jumped up, and after that, as the things started to normalize, demand for debt again started to go up. So your yields started to come up. So we are in that place. If you look at the trend, just there are short-term panics, but rather there are long-term fundamental uh, 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 increases in demand for Indian debt. Right? And that's why if you look at, like I said, there was I said that we are very sensitive when it comes to interest rates also. So for a longer term bond, right, because this is 10 years, are you seeing any sensitivity in terms of the interest rates? Comment on the chat box. Are you seeing any sensitivity when it comes to interest rates? Okay, yes. 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 There is some slight sensitivity when it comes to interest rates, but majority of the sensitivity is coming only from the macro factors that are there. Our CAD, very good. Fiscal deficit, very good. We didn't get affected much, right? Flip side, we would have gotten a very affected had the number for deficit on the budget been bad, but the budget numbers are very good, right? So we saw a big rally on the debt side in the last 2 3 days, right? So stability is there on the macro front, stability is there on the inflation front, which means that India's debt market is just that spread that you're getting right now. You might see not be there. So it's a great advantage, great opportunity for you to actually start looking at debt side. Now, where on the debt side you need to look at, we'll go forward and look at it. Now, long-term story, bond inclusion is very good. You will see a lot of money coming in. That's the thesis that yes, as we get included in the global bond indices, you will see a lot of money that's being pumped in just by terms of sheer virtue of inflows going into that ETF. It would come to us, right? Improving macro fundamentals. You saw from the chart, India is doing extremely well. Fiscal consolidation. All our fiscal numbers are looking really good. In fact, GST revenues are extremely high, which means we are getting a lot of money. You and I are paying a lot of tax. So naturally, there is a good amount of fiscal consolidation that's taking place. Scope for ratings upgrade. Now, this is again a good indicator that our corporate India, that is all our corporate companies, they are doing very well. Private credit versus public credit. That's very important. Public credit always is backed, but here we are having a scenario where corporate profits are very strong, corporate balance sheets are very strong, which means that Indian market, that is Indian corporate, have to go and start borrowing money from the debt market for them to start putting up capacity. Whoever has that sort of ability to take up debt will take up debt, and there is an option for them to go start taking it out from the debt market. So they would come to market, and there have been a lot of conversation. There have been good articles by Uday Kotak also saying that no, the Indian corporates need to go out and start borrowing from the market. Right. So private credit, again, there is a good scope of ratings upgrade. Inflation targeting mandate. Inflation is being targeted very, very well. We are well within that band. So macro, very, very good. Narrowing trade deficit, again, macro really good. You saw the effects of a narrowing trade deficit in the chart where it was a very, very big positive, right? The only issue that comes on the debt side and what investors have this overhang for in Indian debt is that we've never been able to manage our deficits. We've had a deficit crisis always. But this time odd, we have not had a deficit crisis. This time odd, all our macro is sort of in line, and the government is doing a very, very good job. RBI is doing a very good job of making sure that we are neither heated nor we are underheated, making sure that any risks that are there in the market, they are being plugged. Right, unsecured borrowing, that is more personal loans, were also a problem, and the RBI stepped in, giving out more and more data saying that no, this is a problem, and you need to start going and plugging it. So we are very, very proactive because we are very serious. If you're not serious, then this bond inclusion part, right, would not have taken place. Right, the intent for seriousness is very high. That's why we are being looked at by by all global debt investors also. Right, this is the long-term story for Indian debt. What are the risks today? Let's look at this risk. We've had erratic monsoons in the last 1 year. Right, dollar strength. Now, Indian currency is the only currency that has appreciated against all the other currencies in the world, but depreciated against the dollar. Right. Why? Because there is an arbitrage. When we do want that money, we have to keep certain amount of our currency to get depreciated, and that number happens to be somewhere around 3%. Right, 3% is that long-term number in which our currency gets depreciated. Right, but dollar strengthening is some bit of a problem. Right, not only because their macro scenario is not very good, so that means they cannot have a strong currency. We can have a strong currency, but because they are the reserve currency of the world, no matter how much they print, they would not have that big of an inflation issue. This cycle proving to be very different. Where they are having a lot of inflation issues. Okay. Then election spending, I think that part very well covered now. You are already seeing elections starting to play off. That's not even going to be a factor anymore. That was a risk when we see a lack of stability in terms of forming a government. Now that's not a problem. Right, erratic monsoons. This is important. Why? Because we are still most of the growth that comes in India, if you look at agriculture, services, there is a lot of inclusivity that's been happening in India, which means that it's not coming from the metro cities. The growth is not alone coming from the metro cities. Growth is coming from tier 2, tier 3 cities in India. So if we have erratic monsoons, naturally these are the cities, these are the states that are going to get affected. Like we've had 1 year of erratic monsoon, where some parts of India got very high rainfall, some parts got normal, some parts didn't get, they got low rainfall, right? But this year, what they're projecting is a normal rainfall. So hopefully, with normal rainfall going forward, you would see inflation also starting to tame off, right? You're seeing how inflation is affecting your consumption-oriented companies, right? Where they are not making much. You are having a lot of demand issues when it comes to smaller products, not the larger products. But yes, inflation, the effect of monsoon is very high on inflation, and in return, it would come into a pocket, and in return, again, it would affect our global macro scenario, and then again, it would affect our interest rate, right? Global slowdown, definitely there is a global slowdown. Right now, it doesn't look like there's a global slowdown because your equity markets are not reflecting it, right? But if you look at the biggest developed nation, that is US, most of the growth there is coming only from AI spending. It's spending, right? It's not actual capacity that's being put up right now. It would take another 2 years for everything to start playing out, just in terms of AI. But in all the other parts of the market, apart from technology, we are going through a slowdown. There is some bit of recovery that's come in, that is more than what has been expected. Right. So look into my word. More than what had been expected, which means that the expectation set was very, very low. That's why you're seeing people cheering in global markets, right? Import requirements, again, we are not having that of an issue right now in terms of import prices, but we don't know what can happen in, in the months forward, in the years forward, where there is some sort of a problem that comes, like low historic spreads. Again, like I was talking about spreads, right? Which means that the shorter term and the longer term, the spread is very low, right? Usually in history, that sort of doesn't happen, right? So there's some bit of a risk when we take that sort of scenario, because one can go either way, right? One can go either way. So if you take a call on any duration, you're taking that risk today, right? Because you don't know what's going to happen now, in the next couple of years when it comes to global growth, right? Now, so Finesse is our debt side, where they give most of the calls on debt, and they have a scorecard. And you look at the shorter term funds, so they've cut down, they've jotted down everything when it comes to, they've seen all the short term funds, they've seen all the corporate deposits, everything they've seen, and they've given a sort of judgment call, right? So if you look at the shorter term side, like I said, shorter term is very, very attractive right now. So you are seeing good yields here on the shorter term side, for a short term duration of 2-3 years is very good, right? So the judgment is that it's a positive. Like AAA deposits, corporate deposits are still on the 7% side, after tax. All of this, I think, is after tax only, because that's what you get. So the judgment is that no, it's still not very attractive to go towards the corporate deposit side. Corporate bonds, yes, like I said, you saw one particular fact sheet. So corporate bonds definitely is a yes. Longer term duration funds is right now, because our macro scenario is very good. Yes, it is a good option for investors to look at. But however, you look at the shorter term, you're making more of a short term than you're making more of a long term. So there is inverse, right? So there's some bit of relationship, that inverse relationship that's happening on the longer term side and on the shorter term side, right? So naturally, nobody is willing to take a call much to short term. They're willing to take a call on the long term. A while ago, they were not willing to take a call on the long term. They were willing to take a call on the short term, right? So whenever there are anomalies that take place for you, take advantage of the anomalies. Don't leave out the anomalies. The anomaly right now is there on the short term side. So it's a plus. Arbitrage, right now, see, it's just people just go to arbitrage funds because of the tax advantage, but actually don't look at it as a debt product at all. You can look at it just as some sort of a liquid. but people just go there because of the tax advantage and nothing else, right? Target maturity, definitely it's a good option given a particular goal, given a particular horizon, right? Given a particular goal, given a particular horizon, yes, it is, a good option for investors to look at. Now you compare debt products, fixed deposit, your returns are certain. Bonds, they're reasonably certain if held to maturity. You have to hold these bonds for maturity. Bonds cannot be traded. Trust me, bonds you should not trade also. If you get a really good paper, why do you want to trade it? This is not equity. The habits that you have on the equity side should not be replicated on the debt side. Debt needs to be looked just from a point of getting payouts and safety. Right. So if you have safety in your mind, you will not take a bad sort of a call on bonds where you go for higher risk. Right? You would only stick to the payout and you would only stick to safety. Debt, again, is market link. The YTM for debt funds keep changing on a daily basis. Right. So if you are very much interested on the debt side, so you can get in touch with us. We do debt mutual funds. So we do have that sort of access when it comes to daily yields. You would also get it. They will publish it, so you would also get it. Tax fixed deposit annually on the interest. Bonds, it's annual plus capital gain. So because you're buying, and you might sell it, so that that price that you make or the price that you lose also again has to be sort of taxed. The gains that you make also is taxed. Debt is only upon exit. So your tax rate for fixed deposit on the slab rate. Bonds, your interest is on the slab rate, right? And your tax rate is capital gains tax. Then your debt funds again is on slab rate, right? Your timeline on fixed deposit is fixed, bonds is fixed. Like debt funds, you can exit anytime, but 3 years is your sort of lock-in period. So it is flexible. I mean, you have that option to exit because usually bonds, you have to go to the market, right? There has to be a dealer on the other side. Somebody has to be there on the other side for you to go out and sell that bond. You need to go to a dealer saying, I have a bond. I want to sell it. Please help me sell it. But for a debt fund, it's just a mutual fund, right? You can just go to any of their platforms and go and sell, you would get the money. So it's quite liquid. They made it quite liquid, right? Where the nature of that particular product is that, no, you need somebody on the other side where, somebody has to take up that bond. But debt funds, definitely very, very liquid. Now, what to expect from the debt side? More FII flows into debt. Inclusion, bond inclusion, very good. Yield curve shaping, you would see, I would actually do a webinar here on yield curve where you can understand how yield curves have played out in the past and what's happening right now. And wider corporate debt spread. So you would see some bit of a widening in terms of spreads. You would see some bit of widening that's what we are expecting on the corporate debt side. Right. Now let's look at a secret sauce. When do you actually go out and invest which product? Right. Dynamics, you can do any point in time, no matter what your age, no matter what your goal. Ultra short, you should take advantage, in your growing years where you use this as a liquid product, right? Depending on the yields, but you use this as a liquid product, to fund short-term goals, to save some money of whatever you're earning, just to have some 6-8 months of expenses in terms of an emergency, right? Short term, you can take advantage of it in the later stages of your life, but again, depending on what your goal is, short term to medium term, you can take advantage later because you might have some goals that come up at that point in time where you would require, slightly higher yield than ultra short. Not necessary, but depends on that one particular scenario. This is not one size fit all. Depending on your scenario, depending on what your goals are, but right, this is just a normal template that I'm trying to show you. But again, it depends on your risk profile, depends on your goals, and depends on what you have, what you want out of that particular debt product, right? That's what you should be looking at. Corporate, because you are in your allocation when you start to retire, in that debt allocation part, definitely you can have corporate bonds depending on macro fundamentals at that point in time. Wherever that opportunities, usually opportunities turn up this way. So definitely, as your debt component when you retire, you can have corporate bonds at that point in time. Right. So now I'll open the floor for questions. I think uh, we have a good amount of time also again, where we can go through a good Q&A session. I apologize for that two particular slides where we had some bit of an issue in terms of my audio. So again, if you want me to go through a particular slide, please let me know. I'll go through that particular slide again. Right, but whatever questions you have on the debt side, on the macro side, please put in your questions in the chat box. So there is a question saying when bank FDs are also sovereign and also coming with a minimum 5 lakh guarantee with similar tax, why do we need debt at all? See, you debt you need only when, like I said, uh, uh, if you know that these are things that you don't need, the only good thing that comes with debt is that it's very liquid, right? With a debt mutual fund is that it's very liquid, right? Considering MF is subject to market risk, why should we take this sort of high risk in the debt when the basic is safety? Yeah, your basic is safety. The risk that you're taking is some sort of a volatility. Now, when it comes to debt or a debt mutual fund, let's say it's a bad day, or even if it's a really good day, you have to see whether the change is happening on the shorter term side or on the longer term side. Now, because for you it's more on the shorter term side, if the risks suddenly turn against the shorter term side, then please don't take that option, stick to your FD. But if there's some opportunity that's coming up for you, just take it because it's liquid. You can exit whenever you want to, right? Having all the exit loads and all the taxation being paid by your side, if that's not an issue itself from your side, then definitely it's a good option. Otherwise, when you are having that constraint that no, I'm okay to do FD, okay to weather through whatever comes, it's okay. Thing is, your FDs are not priced on a daily basis. Right? Let's say that one day you get to know where FD is going, you would also start to panic. But FD definitely is backed. There is a guarantee by RBI, so it works for people who are okay to forgo liquidity. They don't need this, but if they want something that's more liquid, then definitely a debt mutual fund would work. Either ways, there are charges on both the sides. So if you want to go more onto this side, it's completely okay. You'll just get some extra, some percentage points extra. So if you want to take that, please go there. I would not say that you should go towards that side just because you're getting something extra. Your basic is safety, and you're right. Your basic is safety. You go where whatever is safe. As per SEBI, there are almost 16 plus categories of debt funds. So which one suits whom? How do we know or find out? More practical inputs rather than more theory. I guess as common retail investors, we don't need much theory. Uh, I suppose my view is humble. No, see, you don't need, like I said, if you have a particular goal or if you have a particular need, only then debt will work for you. If not, right, then it's not going to work for you at all. Right? There are more categories on the equity side also, right? But somehow we're very comfortable to go with equity saying, no, I think I know what the risks are. I know what we're playing at. On the long term, everything will play out. So I might as well go on the equity side. But this is not the case here, right? Categories are there here also. That's why I had that one particular side saying, when can you do what, right? So for example, dynamic, I said that you can do throughout, right? Wherever you are, whatever you're doing, because uh, they would make those particular changes when it comes to a particular duration, right? It is dynamic. It's like a multi-asset fund, right? Your multi-asset fund, when the equity goes up, they would go more towards debt. When they would go more towards gold. When the equity is low, then they would have more towards you know when equity becomes attractive, they'll have more towards equity, right? Likewise, dynamic will work anytime. So likewise, multi-asset works anytime. Dynamic will work anytime, right? Right. So right now, the opportunity for all investors that can come up, irrespective of what your goal is in the next 3 years, because usually debt goals are very short term. Shorter term side is giving you that option. right? So depends on what is your goal, depends on what your requirement is. You don't need to be too picky when it comes to what category, because you're going to do it on the equity side anyways. You stick to simple things on debt, right? Don't try to have asset allocation model on the debt side, unless and until you are having a very big retirement plan, right? Try to keep things very simple on the debt side. That's my suggestion. Try to keep things very simple on the debt side. Don't try to complicate anything on the debt side. See, for example, investors, so we did this in 2019 when your GSEC uh, was somewhere around 6%, uh, uh, where the RBI was going to make a lot of changes when it comes to interest rates. Right? We were going through that issue of transition from one you know RBI governor to another RBI governor. Right? When that happened, we found an opportunity on the gilt side where yields had to go down, which means that there was demand for that one particular product coming in. Right? So whoever had that option, where they were okay to take a longer term risk on the debt side, which is more to do on the retirement planning side, there we were able to take that risk. But other than that, there's no need to make things very complex for you on the debt side. No matter what the categories are, don't try to make things complicated and complex on the debt side. Right? Maybe a new war on the Middle East. We don't know whether what is happening on the war side. Something can come up, something can't come up, something won't come up because of other political issues. You've been having a war since 18 in terms of a trade war. So again, you are still in that trade war. So uh, war has been happening for a long time. For 1 to 2 years, which is the best. See, it depends on what your goal is. If your goal is you don't want to touch this money for 1 2 years, something on the ultra short term side would work well for you. Right? Uh, don't try to look at longer term duration funds. Just look at ultra short and shorter term duration funds. Not even medium, shorter term and ultra short term. Who is authorized broker in India? In debt, there's no broker, it's dealer. They've tried to have exchanges where if you go on NSE debt, you would see certain papers being traded, certain papers where you will see the price, but it's not like equity where it's in 1 second, or it's not very dynamic, right? We're still in a very nascent stage in debt, right? You see developing nations, US calls their debt market as developing, so we are far ahead. Right? Because there you see on the equity too many products, debt not too many products. Right? They are still going through a big wave of adding newer ETFs, newer tenures, more complicated, more complex products. So we are very far ahead. We are still very nascent when it comes to debt. Like I said in the beginning, most of it for us is on the government side, right? It's government debt, not private debt. When private debt starts to come in, when private companies start coming to market to borrow money, you would see some bit of maturity. It would take time, but you would see maturity on debt investors, right? And naturally that would come into newer products that come into the market, right? You are already having some complex products on the debt side. Here you're having credit AIFs that are giving you 13-14% sort of return. Again, it's not feasible for everybody, right? It's not at all feasible for everybody. Is it good to start at 60? Yes, it's good to start at 60, no problem whatsoever. Right. Naturally, you would have 20 years or 10 years sort of a goal. So go based on what your goal is. Get in touch with us. I'll put the number. Get in touch with us. We'll see what we can do for you when it comes to debt investing. When the corporate borrowing aspects go up, to what extent will go up? Will it reach double digit? We don't know. We don't know whether it'll reach double digit or not. Depends on what the scenario is. Debt. See, like equity again, when you see bad times on the equity side, equity market goes through 30%, 40% sort of a drawdown, right? But on the debt side, you see spreads widening by a big margin. Suddenly 5% yield on AAA became 9.5%. We don't know how bad or how good as an opportunity it might turn out to be, but there is a risk, right? We were not fixating saying, no, this is going to happen, it's supposed to happen only this way. But definitely there is that risk. So we don't know by how much. Small and cap bank give more returns than debt. What is your view? Like I said, do you want to go towards returns or do you want to go more towards safety? You should be able to answer that question. Short term, for 2 years, parking liquid cash debt fund compared to large cap mutual fund for present. Now, why do you compare why do you compare equity to debt? Please don't compare equity to debt at all. Right? These are two separate products, and the entire industry. I mean, when you read the newspaper, when you are speaking, right, within your peers also, there is always this comparison between equity, debt, equity, gold, debt, gold, right? But relevant comparison need to be taken place, equity to equity, debt to debt, right? Within debt, short term to short term, short term to short term to longer duration, just to see what the spread is, right? So compare debt only to debt, don't compare it to equity, right? If you have that option where you just have 2 years, stick to debt. Right now, the opportunity is on the debt side, not on the equity side. On the equity side, there is only pockets that are trading, at cheaper to fair valuations. But debt overall, right, on the shorter term side, on the medium term side, there is a big amount of opportunity that's there, right? And for 1 year, I have refrained from doing debt webinars because the opportunity had to get a lot more juicier. The opportunity is becoming juicier over time. How can a retail investor trade bonds in the secondary market? I understand your suggestion is to hold bonds till maturity. However, I would like to know, when you take a bond, whoever you're taking a bond from a dealer perspective, he'll be able to sell it for you. Uh, you can tie up with any dealer that's there. Most dealers are, Chola is a good dealer. So, if you have a Chola account, then definitely you can do. There are definite accounts. You can get in touch with your banker. He'll be able to help you out. But because it's dealer driven, ensure that costs are well contained. So you have a couple of more minutes. We have another 2-3 minutes. So if you do have certain questions, do put it in the chat box. I've put out the number also. So on Milestones2Wealth, we are looking to add debt for investors. Depends on what their goal is, depends on what their scenario is. So we are doing that. So if you are interested to building a debt portfolio, do get in touch with us. Second, we are also dealing in bonds. We have tied up with certain dealers. So if you are interested in investing on the bond space, if you want to know what the interest rates look like on the bond space, do get in touch with us. There are corporate FDs also that we are doing. So if you do have some sort of a requirement, get in touch with us. But majorly, I would suggest debt mutual funds work the best. If, again, what your requirement is, we will be able to match it. We've had a 40-year low interest rate in the US. Will India go through a similar scenario in the next 10-15 years when it accelerates growth? This is a superb question. See, when it comes to first, let's compare India to US. India is unique. India is very, very unique because our demographic profile is very different than what is there on the debt side. And second, where growth comes from in India is very different, right? South has a particular growth, where it comes from. West has, North has, East has, right? So India is very unique. India is very dynamic, both in terms of culture, both in terms of demographic profile. Right. Now, because we are having a lot of population that is very, very young, right? Your average age somewhere is in the low double digit, right? Uh, because our average age is very young, we are having a big workforce, right? If you look at the unemployment rates, surprisingly, right now, between the 21 to 30 age group, unemployment rate is quite high, right? And these are individuals who are having a master degree, right? So we are having some certain issues when it comes to unemployment, unlike that of the US. Right? The US went through a wave of growth, and after that, significant changes when it came to their demographic profile. In relation to that, they are seeing high levels of debt. Right? Uh, uh, so I have some data which I don't know if I can project, but I can definitely tell you what what the demographic profile looks like, and why do you see that debt in the US has suddenly gone up. They've printed a lot of money, but their debt has definitely gone up. So given that profile, right, they are having a good chunk within Gen X and boomers, and the boomers are starting to come down. Right, millennials are coming up, Gen A, Gen Z also very small, right? But Gen X, starting stage millennials and boomers are quite high. So millennials actually make up the largest population in the US, and they are coming of age, right? They are coming of a certain age. So when you look at all these factors, right, that's why you're having this scenario where they're struggling for growth, where they're getting more and more into technology oriented companies, where they are investing more on the tech side, where they can increase productivity. Right, their unemployment rates also are quite high, given the size of the nation. Given the size of the nation is quite high, but for us, not very high. Right. So when India accelerates on the growth side, we will be able to sustain growth. Right, because we are not having the same issues as them, right? We are very unique. We are not having the same issues, right? Because we are not having those same issues, given whether it is 30 years from now or 40 years from now, we are not having those issues. You look at China today, they are having a population issue. Right? You look at Japan's example, they went through, a very dark phase in their life. And now they're opening up their economy, they're opening up their country, saying, no, everybody can come here and start living here. You can, you can settle down here and we'll give you all the benefits possible because they're having that much money now. Right? So we are a country that can sustain, good growth. We can sustain. Right now we are able to, our view is that we will be able to sustain high growth, that is somewhere around 7-8%. And going forward also, because certain aspects of what drives growth, that is your resources, your natural resources are very good in India, your workforce is very young in India. Because these factors are supporting that sort of growth, we would not have the same issues as what US is having. You might have different issues. Definitely we will have issues, but we will not have the same issue. We can always look at the West, and can always look at the other countries to learn from them as to why their scenario is like this, and what can happen to that particular scenario. What are the outcomes that can take place there? But ultimately, we have to tailor make solutions to our issues, not the same issues. So our issues will definitely be different, uh, not unlike the US. And we are a developing nation. We will always be called a developing nation because we are very young. What role performs PNB Gilt in the bond market? I would just talk about Gilt, not about a particular product. Gilt is longer term. So if the tenure does well, your Gilt will do well. That means if the demand for tenure, that is demand for longer term papers. Why does the demand for longer term paper go up? When there's a lot of stability on the long term side. When there's no stability on the long term side, you would see that there's not a lot of uh, demand for longer term papers. Naturally, you would see that the yields are higher. So you have to take advantage of only certain scenarios like this, where the yield is on the higher side. And then you have to do some sort of checklist to see if the macro is good. What are the changes that can take place for our yields to come down? And then if it makes sense, definitely Gilt is there. Even on the scorecard, Gilt was a plus, but more opportunities coming on the short-term side. Interested to know what kinds of corporate bonds you deal with. So I won't be able to tell you right now on the webinar, but just send us a hi on this number, and we'll give you all the details. No problem. Great. I don't think there are any further questions. Because I'm doing that for the first time also, please leave me a feedback. I want to know what I can improve upon on the debt side, and make sure to give you all relevant content. So if you have some suggestions on the content side, if you have some suggestions on how you want certain webinars on the debt side to be, please do comment, please do get in touch with us, and I'll make sure to put out the best. Done. Thank you so much for your time. Have a great weekend ahead. Thank you. Do attend all our debt webinars. Finesse is our uh, platform for debt. They do a lot of debt. They do a lot of complicated debt. I wanted to keep debt for Milestones to be very simple. They do a lot of complicated stuff. And when I was going through their presentations also, I had to sit with one of the debt analysts saying, listen, please explain this to me. But nonetheless, if you do want some sort of complexities, do get in touch with us, or just type finesse on YouTube or Twitter, and you will get all the handles, and you can follow them. You will get all the notifications when they do a finesse webinar. Thank you so much for your time. Have a great weekend. Thank you.